My next guest is someone who is not only a very, very close and dear friend, but someone who is an incredibly courageous patriot who has dedicated his life to providing information to enhance your economic and financial freedom. He goes by the name, as name de plume on the internet, is Turd Ferguson, but his walking around street name is Craig Hemke. He founded an organization by the name of tfmetalsreport.com. I am a proud paid subscriber to that site, have been for many years, and I believe it's some of the best money I spend every month. Why? Because of the community he has created and because it gives you 24/7 access to his analysis and his interpretation of what's really occurring behind the curtain. And for you to maintain or enhance your economic and financial freedom and liberty in this day and age, you need someone who has the analytical skills and abilities and that is focused on your well-being. And that is Craig Hemke and tfmetalsreport.com. In his bio, Craig states that he was a licensed security professional for nearly 20 years and became disgruntled by what he calls the fraud known as financial services. He retired to a career as a serial entrepreneur, which has benefited millions of people, not just in our country, but around the world. It is my honor to introduce my friend who I've described as a Cat 5 hurricane force in the internet blogosphere, Craig Hemke. Craig, welcome back to the Operation Freedom Platform and DaveJanda.com.
Doc, you're always so effusive in your introduction. I don't even want to stop you. Keep going, please.
That's all I'm going to go. It's all on the table. So, hey, Craig, one of the things that you have a knack for is you talk about issues in a particular time frame that are always way ahead of the curve. And you get all these boo birds, not so much on your platform, but in the social media, that attack you for the statements you make. And then 6 months, 12 months, 18 months, 24 months, it plays out just as you were speaking about. And I bring this up because many months ago, you were talking about, look, we need to watch out for stagflation. I mean, look, this is going to be a huge issue in the financial world. Craig, you got slammed. You got slammed on social media for speaking about it at the time. But here we are, and I'll just run a couple headlines by you that the deep state doesn't want people to know about. But U.S. building permits plunged to 8-month lows in June. Manufacturing survey disappoints in June. Signal looming stagflationary threat. We got Bidenflation, cost of gas, used cars up 45%. Car rental costs up 88%. Moving costs up 17%. Bacon up 8%. Shoes up 7%. Craig, all these headlines point to exactly what you spoke about many months ago that was coming down our future that you got denigrated for speaking about.
Well, I guess I don't want to pat myself on the back too hard. It's not like we're splitting atoms here, Doc.
No, go ahead. You deserve to.
But the thing is, after a decade of plus now of watching the precious metals, I've tried to get away from trading in short-term stuff, and I focus more on what I call just the macro, get the macro right. As you know, my annual thing I put out in January I always call a macro cast, not a forecast. Because if you get the macro right, you're generally going to be correct about the stuff that happens, in between. But nobody cares about that stuff anymore, Doc. I mean, even with my extreme ADHD, I've got a better attention span than most people in financial services and investors. I mean, everybody just want 100% gain, and they want it by, next week sometime. And if you can't provide that, then they're not interested, And so when you talk about normal, big picture, macro stuff, that we all used to talk about, even as recently as 10 years ago, a lot of people brush you aside, especially if it's perceived in any way to be negative, because nobody wants to hear negative. They just want to know that, their Schwab account's going to go higher, and that sort of thing. But this stagflation, as you mentioned, I mean, this isn't complicated to have seen this coming, because on one hand, you knew that, we were blowing out these massive multi-trillion-dollar deficits, and that, funding was going to have to come from somewhere. So that's new cash being created by the Fed. You knew that all these people that lost their jobs, they were going to be getting, direct assistance from the government. That's new money going straight out to people. And so that you end up with too many dollars chasing too few goods. Well, that's pretty obvious. That's an inflationary cost. But you also had to figure, and again, this is going back to just after COVID, took hold a little over a year ago. You knew that businesses were going to have to adapt and adjust if they were going to stay open. And a lot of that is, trimming the bottom line, trimming employees when they need to, trimming their office space and overhead and everything else. And once you get used to that, once you get used to having Zoom calls with your clients rather than traveling all over the country, then, the employer with the big fat T&E budget says, you know what, we got by with half of that last year. Let's do it again half this year, and you can keep doing Zoom. Well, that trickles down, man. There's not as many hotels that need to be rented. There's not as many, and so there's less people that need to have jobs at hotels, and the cleaning crew, and then you don't have as much office space that you need, and so you downsize on your office space, and all these things add up to where. And we still see this. Maybe even by the government statistics, Doc, we're 11 million jobs down from where we were in February of 2020. And those aren't all coming back. We've already seen that. And so put all that back together, you knew there was going to be inflation, but there was going to be a very long slog back to get anywhere near where the economy was, in 18 or 19. And maybe that's not the traditional sense of stagflation, but it's pretty dang close. And if you get that right, then you can kind of, can try to formulate an investment plan from there.
Well, and when we look back historically, at least in recent memory, the biggest period in our country where there was stagflation were in the late 70s, early 80s, correct?
Yeah, that was when you were, what were you, about 30 or 40 back then, Doc? You probably remember it well.
No, I was like 20. Come on. Gee, it's 30 or 40. Yeah, well, okay, No, actually,
I was watching.
I was in my 20s. Come on. I mean, I'm old. I'm old.
Not
that
old. Well, I was coming. I'm coming home from school watching Gilligan's Island. In 1978, and so I do at least have some memory of it.
Yeah.
And it was that same type of environment. You had extensive inflation. You remember Gerald Ford, Whip Inflation Now, and you had Jimmy Carter with his malaise, and the whole thing combined to a really tough time, especially for people in the middle income range back in the mid to late 70s. And the only way that was combated, I mean, that was a period of sharply what we call negative real or inflation adjusted interest rates, where inflation was 15% and your CDs or treasury bonds were 10%. And so you're actually losing 5% a year versus like cost of living on just your traditional investments like that. And that's kind of where we are again now. I mean, we're not dealing with 15 versus 10, but we're dealing with 5 versus 1.
Right.
And it's similarly just a very challenging time for people who are trying to get by on their savings, people, the older folks that are, trying to live off of interest income and not eating into their principal and all that kind of stuff. It makes for a very difficult time for a lot of people.
Well, back in the late 70s, early 80s, my dad said to me, he goes, look, the last time I saw something like this is when you go for hard assets, buddy boy. This is where hard assets do the best. So here we are in 2021. And as you mentioned, the real interest rates are very much negative at this point, with a inflation rate of whatever they're telling us, 5%, and a 10-year bond at 1 point something percent. So, so here we are, again, in a big negative real rate environment. So one would think that we'd be seeing gold and silver doing pretty well, and they're doing pretty well, but maybe not as well of late, not as well as they were a year ago, back in August of 2020. So where do you see the gold and silver markets at this point, Craig, and where do you see their future over the next several months?
Yeah, Doc, it has been grueling this year in that regard. We went up so fast last year. If we went back to a year ago right now and, like an ounce of silver was $20 and now it's 25, you think, okay, well, that's pretty good. That's up 25%. But the problem is it went to 30 a couple of times between then and now. And so 25 doesn't feel so good. And at the same time, you go back to the first of this year when I was writing that macro forecast I was telling you about. If you'd have told me, hey, guess what, Craig, by July, the CPI is going to be annualizing north of 5%, but that 10-year note's still going to be under 1.5%. I'd have thought, oh my gosh, gold's going to be $2,500 or $3,000, and instead it's $1,800. The fundamental issue that we have is that the price of gold, silver too for that matter, is determined by the trading of futures contracts in New York and in London as well, unallocated futures contracts. And as long as that's how the price is determined, then again, it's like anything else. The price is going to be found by the supply and the demand. And if you've got more supply than you have demand, then price falls. And right now we have just the traditional buyers of those futures contracts, whether they're hedge funds or institutions or speculators and traders or whatever, they're not buying. And so there's not that much interest in, and so the prices kind of keeps drifting lower. And the reason they're not buying is they've all been convinced by Jay Powell and the Fed that this inflation is transitory. That word they keep using over and over and over again. Oh, it's just transitory. Doc, it's transitory. You're wondering, it's transitory. And because they're convinced of that, everybody looks at that real interest rate that we talked about, that's negative 4%, and says, but, by this fall sometime, maybe it'll be back down to only 2% or 1%. And so what will happen, at least what I'm expecting at some point, is this notion of transitory will fade away. And people will realize, wait a second, this isn't going away. This is like the new normal. And then gold will rush and silver will rush to catch up again, a lot like what they did last year. When gold had gone sideways, silver had gone sideways for 5 or 6 years, then all of a sudden exploded higher. And they're going sideways again. So you hit it right, Doc. They are your best protection in this type of economic environment. They're by far your best protection against the crazy madness of the politicians and their bankers. And a lot of times you just have to be patient, and wait for them to move. But you feel pretty good at night knowing that you've got at least part of your investment dollars allocated to something that is actually sound money rather than dollars.
Folks, we're speaking with Craig Hemke from tfmetalsreport.com. I encourage you to go to his site, and I also encourage you to be a subscriber. Craig, many people believe the reason why the price of gold and price of silver have not skyrocketed as they should have with real rates where they are at this point is because the powers that be, if you will, utilize computer algos to, let's call it, harness the price. First of all, I want your take on that. Second of all, someone I know very well in the IT world has always told me, Dave, you know what? I have yet to meet an algo that is immortal. So your take.
Well, you're absolutely right. I mean, we have a documented history now of, government, central bank, government, and even big bank interest in controlling the price of the precious metals. And they do that for a number of reasons. The reason why the central banks and governments have an interest in controlling the price of precious, gold in particular, is because when you're on just a simple fiat money system, which is what the U.S. has been on now for almost exactly 50 years. We're coming up on that anniversary in about 3 weeks, when Nixon suspended the convertibility of dollars into gold. When you're on that kind of system, I mean, that's just basically based on confidence. I mean, when the dollar is just simply backed by the U.S. government's ability to tax and then print more, that's a confidence scheme. And it only works until people no longer have confidence. And that's what's happened in Weimar Germany back, between World War I and World War II. You lose confidence in the currency, and that's when things really get away from you. So what would a soaring gold price mean in terms of confidence in the currency? And that's all part of why they have an interest in controlling it. But right now, absolutely, you could make this case, Doc, because the biggest fish that the Fed has to fry is keeping interest rates under control. Mm-hmm. That's why you hear this talk. People hear this on CNBC about, well, they're going to taper this, and why are they still doing all this QE when the economy is doing better? Well, because if the Fed wasn't buying $80 billion of U.S. Treasuries a month, which, again, you do that math, that's $1 trillion a year, then somebody else would have to. And again, this is about supply and demand. If you've got more supply than there is demand, then prices fall, like I just explained with gold futures. Well, in the bond market, if prices fall, that means interest rates are going up. And the U.S. government, again, we've got, just to make it easy, to make the math easy, $30 trillion in outstanding debt at an average interest rate. Think of this. We've worked it all the way down to 1.5%. That's $450 billion a year as a line item, interest on the national debt in the budget, if there was a budget. Well, if that interest rate doubles to 3%, well, all of a sudden you're talking $900 billion a year. If it were to triple up to 4.5%, or let's say 6%, right? Remember, I'm sure people listening remember getting 6% on a CD or something like that, a couple decades ago. Well, now you're talking, what, $1.8 trillion a year just in interest? I mean, the whole thing spins out of control that much faster, notwithstanding, credit card debt and student loan debt, state municipality debt, and just goes on and on and on. So what the biggest fish that the Fed has to fry is to keep rates down, which is why QE continues. And when you hear this word transitory from Powell, and you'll hear it again this week because, believe it or not, there's another FOMC meeting that concludes on Wednesday. You'll hear all transitory again. That is a form of yield curve control. That is jawboning. That's Powell and his minions trying to convince the traders and buyers of Treasury bonds to keep buying. Because if they say, oh, no way, I'm buying a Treasury at 1.5% because inflation's actually 4%. I'm guaranteed to lose 2.5% a year of my purchasing power. I'm not. But if you can convince them that inflation is transitory, then maybe they'll keep buying. And if they keep buying, then rates will stay down for the reasons I just mentioned. Well, okay, then put it all back together. What you asked me, Dave, if gold was soaring this year, as it should, off of these negative real rates, well, how does that fit the transitory narrative? How does that fit that confidence scheme narrative? It doesn't. And so, yeah, is that part of the problem this year too? Yes, I'm certain it is.
Speaking of problems, let's do a little name association. When I say the name Jamie Dimon,
what am I supposed to tell you what I think?
Yeah.
Criminal.
Yeah.
Head of a criminal mafia.
Jamie
Don.
Dimon is the CEO of JP Morgan.
He's the head of a criminal organization
that's actively involved in, would you say, and has been over the ensuing decade, in suppression, manipulation of the precious metals market as determined by information that has come forward. Would you say that's accurate?
Absolutely. And when I say he's a head of a criminal organization, that's just not me just like throwing terms around. Anybody listening to this, just Google, well, maybe you don't want to use Google, go to some other search engine and type in JP Morgan fines and just start reading every line of business, not just the $920 million they've paid in fines for manipulating the precious metals through their precious metals trading desk. Not just that. Every line of business, they just figure, well, we're just going to break the rules until we get caught, and if we get caught, we'll give back some of our profits. That's how they operate. So it's not like I'm being hyperbolic here. I mean, that's just what they are. That is how they run their business.
So this week, headline, Jamie Dimon pays himself 8-figure bonus for agreeing to stay on as CEO from Zero Hedge. We now know the real purpose behind the media manufactured groundswell last year of support for JP Morgan CEO Jamie Dimon to run for president. The longtime JP Morgan CEO just received a, quote, special award, end quote. I agree with you. It should be an indictment. But no. Here's his special award in the form of an options package worth 1.5 million shares for agreeing to stay on at the helm of the bank. The bank, which is not only the CEO, but also chairman of the board for a, quote, significant number of years, end quote.
I'm sorry, Doc. I could vomit.
I just did.
People are going to look back. People will look back on this period of American history, and I don't know, with shame almost on us that we allow this sort of thing. With the disparity, and the people that are out of work, honest, hardworking people that can't find a job or are trying to do 3 gig jobs at once, trying just to feed their family, and you got slime balls like Jamie Dimon cutting himself checks for $10, $20 million. It's awful. And it all goes back. And again, at the risk of being hyperbolic, and I know we're getting up against a hard break, but this all goes back to when Nixon closed the gold window 50 years ago. The Fed has been printing cash ever since. That the Fed is at the heart of all of our income and wealth disparity that has only widened over the last 50 years, and it's only getting worse. This is a perfect example of why and how it's getting worse, and it is never going to get better until we eliminate the Fed, we eliminate the central banking system, we go back to some form of sound money. And how we're ever going to get there, I have no idea, but it'll happen eventually.
Craig, I'd like to thank you for everything you have done, are doing, and will do, folks. I encourage you to go to tfmetalsreport.com.